Something massive just went down in China and has experts warning of a looming crisis, one that could hit every corner of the world. Now let's over to Bloomberg, where he picked today's story up with the headline, as U.S.-China trade talks start in London aiming to ease exports curves. And all of a sudden, we're seeing both sides want to come together to negotiate, at least at some level. And there's a good reason why, because when you start to understand what just happened in China, well, we look back to the beginning of this trade war, and what did we find out? It was a game of economic chicken, whose economy was stronger. And right now, what we're finding out is China's economy is weakening and fast. But the U.S. isn't immune, and we want to make a deal just as much as they do, because right now we know that the rare earths are hurting some U.S. manufacturers. We're seeing our economy slow down, and we could be a matter of weeks or even a month or more away from seeing the unemployment rate rise. All of a sudden, both sides want a deal, but as you're about to see for China, the urgency is now, because what we're facing is a crisis, one that could spread all across the world. As China's exports to the U.S. clocked their sharpest drop in more than 5 years, now down over 34% in May, and we know this is going to get worse in June. And this is a major problem, because what you're seeing from the world's largest exporter is demand from the world's largest importer due to the tariffs has plunged. And this is going to cause problems on both sides, but it's going to hit China first, because at the factory level, suddenly, without a lot of orders and allowed a lot of shipments going on, what you're going to need is a lot fewer employees. Now, this is going to impact the U.S. in a different way, but it's also going to hit our labor market. And this is a problem, because when we look at who has the staying power to survive, China's looking to stimulate their economy. But based on what we're seeing, the damage is already done, and it's about to get even worse. Overall, exports rose 4.8% last month in U.S. dollar terms from a year earlier, as we noted that China was likely going to send exports to other countries and use them as a gateway to the U.S. We can largely assume that the Trump administration has now shut that off to some degree, meaning that China's reliance on the United States as a trade partner is going to drive their economy into even worse shape. And wait till you see what's going on there, because what it indicates is all-out global chaos is imminent. Imports plunged 3.4% in May from a year earlier, a drastic drop compared to economists' expectations of a 0.9% fall. Imports have been declining this year, largely owed to sluggish domestic demand, and that is a key point here. So not only are we seeing a decline in global demand, particularly due to the tariffs and slowing global economy, but internally for China, they're seeing demand go down, and it makes perfect sense. As Chinese consumers look around the world and they see everything else is slowing down, they're seeing it impact their economy and their factories, and now their demand is dropping. And for China, this means potentially an all-out recession. But I'm going to make the case of why they could be seeing a financial crisis when they could spread all across the world. As we look at imports of goods and services into the U.S. in blue against the unemployment rate in red, and what I want you to see here, as global trade goes down, demand for workers all over the world is going to decline. For China, it's going to be at the factory level. For the U.S., it's going to do with imports and trade. Let's take a look at what happens. We go back to the late 1980s. What do we see? Imports decelerate. The unemployment rate heads higher, right into the 91 recession. We see going to the dot-com bubble, imports crash and then go into contraction. The unemployment rate heads higher, again, right into a recession. And the financial crisis, same recipe. And now what are we facing due to the tariffs? We already know it's here. Imports to the U.S. crashing down. That means at some point the demand for U.S. labor is going to go with it. Now, at the beginning of this, what have we been hearing from employers? That they want to hold on to as many people as they can. The problem is they're going to do something else and it's still going to have a massive impact on the economy. But even if China and other nations are able to strike a deal with the Trump administration, demand from the U.S. and elsewhere might still weaken as companies slow down their frantic purchasing aimed at beating the tariff. And that is another key point, one that we've warned was likely to happen due to all this front running of tariffs. It doesn't matter if the trade war goes on a little bit longer than everyone expects, because right now we have too much inventory at a time when consumers all over the world, it's not just Chinese consumers, it's U.S. consumers that are feeling the fatigue of high inflation and yet at the same time shrinking paychecks and the worry about their income going forward. What this is leading to is a decline in demand. Then on top of that, we have a massive inventory overhang that needs to get worked through. So in the end of the day, what's happened in China with this decline in demand would have happened anyways, but the trade war now only making it worse. But something that should be getting better, that's the direction of your trading account. Let's talk about that trade we put onto GDX back on May 30th. We put a buy it open to our Momentum Timer Pro subscribers. As we noticed, not only were the technical indicators rising, but the trend was up as well. That trade now up 3.55% as of Friday's close, and based on the charts today, it's headed even higher. If you want to trade momentum like we do, grab the links in the description below. Use the coupon code for your free 30-day trial. Stay tuned to the end of the show for more information, and you're not going to believe what's coming for our Momentum subscribers. They're going to be blown away when we announce this. It's going to be incredible. You want to get in now. And let's take a look at imports of goods and services now overlaid against average weekly hours of production and non-supervisory employees, because again, we listen to what employers here in the United States have been telling us, and that's they want to hang on to their employees as long as they can. The problem is they can't afford to. So what are they going to do? Is they're going to cut hours. And this is what we're seeing in the sentiment surveys. This is what employees are worried about. They see their income is going to go down, and then they realize if new orders don't start coming in, they're going to be out of work. The problem is, if we see any further decline in hours, meaning shrinking paychecks relative to rising inflation, it's still going to have a devastating effect on our economy. Let's take a look at what happens going into the 91 recession. We can see there's a reason imports are going down. It's because consumers can't afford as much. We know inflation at the same time was headed higher, but look at this, average weekly hours on the decline, pushing us right into the recession. We see around 1994, this was a soft landing of the economy. And why was it soft? Well, because hours dipped, imports dipped, but luckily they both turned around before we found out we were headed right into the dot-com bubble. And again, you see one of the leading indicators. It's not just demand, it's employee paychecks. Again, weekly hours on the decline, just like we saw it going into the financial crisis. Happened again in 2013, around 2015 and 2016, and right before the pandemic. So as we look at where things are at now, hours have really not kept pace with the increase in imports. And now what are we facing? A big decline in imports. We know it's going to lead to a lot of hours getting cut for workers who are already struggling with inflation, which means their spending is going to go down. It's going to have a massive impact on the discretionary side of the economy. And then, just like what we're seeing in China, it's going to backfeed all across the economy, because it's not just exports that tumbled in China. Look what happened to their housing market. As Country Garden's May sales dropped 28% with no revival in sight. Now keep in mind, it wasn't long ago that Beijing stimulated the property market. They were excited because it started to work, and I told you it wasn't going to last because the economy was weakening in China, not to mention the entire global economy. Sure enough, now we're seeing housing plunging. This is a major problem because you think about what Beijing did. They went to the banks and forced them to loan money to these property developers. They cut rates, and now what's happening, what you're finding out is these property developers are on the brink of insolvency. Deflation could bring the entire housing market crashing down. But the problem is, it'll take the entire Chinese banking system with it. And if you think the world banking system is immune, not so fast. It'll spread like wildfire. Falling consumer prices in China are eroding corporate profits and employee income, leading to suppressed demand for home purchases, just as the effects of the stimulus blitz last September start to wear off. And again, the odds of the stimulus even working long enough to turn the economy around was a complete myth. But this is the problem when you have a forgot to grow economy mindset, is you look to stimulus to solve the problem, China not realizing the real answer is you need the global economy to expand. And with the trade war now in full force, China's got a major problem, one that doesn't look like it's going to resolve. In fact, if anything, could push the entire global economy into all-out chaos. Buyers remain concerned about developers' ability to finish products on time, leading new home sales to drop since March after a brief period of stabilizing, and for good reason, because in China, you actually buy the property before it's done being built. And you can already see the consumers are smart enough to realize that if they give the developer money who is likely insolvent, the odds of getting your property, well, is pretty low. But let's turn to the US data because we are going to face the exact same scenario. Let's start out by talking about inflation, because when you have a problem with inflation, the biggest cure is shrinking paychecks. Of course, in China, they mentioned that inflation was a problem because it was going the wrong direction. It was going down, not up. And that was leading to less average hourly earnings. And sure enough, we see that in the US data. As we look at the consumer price index in blue against average hourly earnings of production and non-supervisory employees in red. And what do we see? Periods where inflation is going down, what happens? The pay raises go down with it. You see that happen during the dot-com bubble. Of course, during the global financial crisis, as deflation takes hold, companies realize you don't have to give out big pay raises because people are happy to keep their job. And look where we're at now. We note the Fed is concerned that, of course, average hourly earnings remain at a rather high clip, but what they can't see is consumers struggling with inflation. And as disinflation continues to persist in the U.S. economy, what it means is we're going to see smaller and smaller pay raises. But the first thing that's going to happen, and the big one, is hours are going to get cut. And you can see the same thing likely happening for Chinese workers, as what we see now is average weekly hours of production non-supervisory employees in red leads the consumer price index lower. Happens each and every time. Businesses can raise prices all they want, but if nobody comes in to buy, prices will come down. And you can see that happening right now as we head into the next global recession. Hours worked are on the decline, likely to roll over now as we face, of course, the end of all this front running of tariffs. We know, again, employers are going to do everything they can to keep employees. But the sacrifice is they're going to get fewer hours. Fewer hours, again, less money spent on the discretionary side of the economy. You start thinking about that massive inventory overhang, and what does it tell you? More disinflation, and we're going to likely see pockets of deflation in the months to come, unless magically that inventory gets moved. And based on all the indicators we're seeing now, it's not likely to happen. But let's talk about the correlation between China's housing market and the U.S. housing market, because we know that consumers don't want to buy because they're concerned they won't get their property. But look what happens in the U.S. We do things differently here, of course. We don't pay until we take ownership, but look at the relationship between wages and new privately owned housing. You started that in blue. And we're going to look at total income now in red. That's a combination of weekly hours and average hourly earnings. And what you can see, going back to that soft landing in 1994, what happened? Total wage growth was actually slowing. Housing starts came down. You see it going in the dot-com bubble, wage growth decelerating. People at first said, no problem, we can afford houses, and builders kept building until housing starts came down. And again, you notice this relationship. A decline in housing starts tends to lead recessions, and it makes perfect sense because the housing market employs a lot of people. Let's take a look at what happened going to the financial crisis, because you see total incomes are decelerating. At the same time, housing starts plummet. Of course, we go right into a massive housing-led financial crisis. And right now, builders remain optimistic. Buyers say not a chance. But what's likely to happen going forward is we're going to see wage growth decelerate, and that means housing starts going down. The reality is the U.S. economy facing one step behind of what China's is. And now you see the motivation. Why do both sides want to make a deal? Well, we know China is likely to be in a more desperate situation here. What I want you to see is the U.S. isn't far behind, because something else that's happened in China, well, that is deflation, and something likely to come to U.S. shores. As China consumer prices slump again, deepening deflation worries as demand stays weak. And something we noted in the U.S. economy, and why I want you to understand what's happening in China right now is going to spread all across the world. It's already started to, but it's only going to get worse, because we're seeing and hearing from U.S. consumers that their desire to spend is going down. And we note that there's a link between consumer sentiment and consumer spending. The moment U.S. consumers get worried about their finances, the wallet tightens up quick. And China's consumer prices fell for the fourth consecutive month in May. That's right, 4 months of deflation, as Beijing stimulus measures appear insufficient to boost domestic consumption, with price wars in the auto sector adding to downward pressure. And we mentioned that this would likely happen because, again, China's economy, highly dependent on the rest of the world. Doesn't matter how much Beijing stimulates, if people are worried about their job and their income, they're not going to spend no matter where rates go. The CPI slipped into negative territory in February, falling 0.7% from a year earlier, and has continued to post year-on-year declines of 0.1% in March, April, and now in May. And you can see what happens in China does spread across the world. While a lot of people think our economy is an island to its own, we're all interconnected. So again, as demand from China goes down, eventually it's going to hit other parts of Asia, Europe, and it's going to happen here at home. Separately, deflation in the country's factory gate or producer prices deepened, falling 3.3% from a year earlier in May. Now, what's notable here is China exports deflation, but due to the tariffs, well, clearly they're not exporting the deflation like they used to. So this is actually kind of a good thing for the U.S. because we know if we start to see deflation hit, well, it means China's competing with our factories, something the Trump administration doesn't want. Problem is, it's what consumers really need. They need some price pressure to abate, and we're not seeing it. And that marks the steepest decline since July 2023 and a sharper drop compared with analyst estimates of a 3.2% fall. Wholesale prices have remained in deflationary territory since October of 2022. So you could see China's economy in a dire situation here. They're likely to see even further deflation. As we take a look at this chart, you can see producer prices in dark blue against consumer prices in light blue. And where producer prices go, well, eventually consumer prices follow. And what we're seeing due to the lack of demand in China means that lack of demand is going to hit U.S. factories. In fact, we're already seeing signs of it happening. That means deflation is coming here at the factory level. It's going to continue to pull, of course, consumer prices down, put the Fed in a position that they're going to have to cut rates. But just like we're seeing the stimulus in China not work, well, it's not going to work here either. But yet, that doesn't keep China from trying, as now their banks are cutting the deposit rates to aid margins. And here's the big one: drive spending. But the challenge here, again, you come back to the economy. If people are worried about losing their jobs, if they're worried about their income or their income shrinking relative to rising prices, what are they not going to do? They're not going to borrow. Now, of course, what we do know is that banks want them to come out and refinance their existing debt, create some cash flow, and hopefully spend that into the economy. But again, if there's no signs the economy is turning around, people are going to save and not spend. The cuts on the country's more than 300 trillion yuan of deposits came as a recent package of government measures to stimulate the world's second largest economy, has further squeezed bank profits. But again, you just sacrificed your banks, because if the economy goes down, your banks go down. But the problem is the housing market, and that's what I wanted you to really see here, is already telling us that the Chinese banking system is about to blow apart. And again, that chaos is going to spread all across the world, but they're going to stretch the banking system all the way to the end, and then you're going to watch it go. Driven by persistent state efforts to push down borrowing costs, China's 10-year government bond yield has fallen steadily in the past few years to about 1.66%, around a record low. So what is China's bond market telling us? That things are going to get even worse there. They're telling us they're not going to turn around, because keep in mind, long-term bond yields are a function of growth and inflation expectations. So China's bond market is saying, look, the deflation you're facing, it's going to get worse no matter what the stimulus you do. And growth? Well, this is only the beginning of the decline. And we can see that here when we look at import price coming into the U.S. from all industries for China. That's shown in blue against the 10-year Treasury yield here in the U.S. And what do we see? When import prices are going down, what happens? Interest rates are going down. It makes perfect sense because, again, interest rates are a barometer of growth and inflation expectations, suggesting we could see a large move down in 10-year yields here in the future. It could be a huge trade for a lot of people. Hasn't started yet, but you can see based on the relationship, it's coming, and soon. In China's prolonged property crisis, deflationary pressure and worries about unemployment are weighing on confidence among households, and for good reason, because what it's telling us is consumers are actually very aware of what's going on in the global economy. They're worried we're going to have a recession at the very least, potentially an all-out crisis. It means they're cutting their spending, they're saving more, and despite government efforts to stimulate, what you're seeing is China's economy implode under the weight of a slowing global economy and the trade war, suggesting we could see a resolution soon, But the reality is, what I really want you to understand, it's too little, too late. The path China's on, they're going to drag the entire world down with them. But if you're looking to make some money trading momentum, let's talk about our Momentum Timer Pro Report, because we've shown you tons of our trades. And now how do we do this? Well, each and every day we look at the tactical indicators like the RSI and the MACD, and we aggregate them together and we look for when they're coming out of oversold territory. But one thing we do that gives us the edge is we pair it with the trend, because you can come out of oversold territory, but you can find out that a security can go from oversold to oversold and oversold, and the price can go right down with it. But when we see it come out of that territory along with a rising price trend, well, it shows up on our hot list. Now, in addition to that, you get, of course, the momentum indicators across a 1 day, 1 month, 3 month, and 6 month window. And on top of that, you get the report, you get all the tradable signals, you get my opinion on the best trade. So even if you don't want to read the report, I tell you exactly what trades you should look at. And on top of that, I give you risk control levels, a full tracking of all the open trades and returns, and a weekly update. But we have a big announcement coming for Momentum Timer Pro subscribers. It's going to blow them away. You want to get in on this while you can and lock that price in. But before you do that, make sure you grab that 30-day free trial. All you have to do is grab the links in the description below, use a coupon code for your free 30-day trial. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.